Okay, let's start on today's topic, the risk and return, and that's covered in chapter 6 of your book, I believe. Um, that's where we are. Yes, chapter 6. I just opened the book to confirm that. Um, but the topic is risk and return, and you can say that talking about there being a part one, and then there's going to be a part two because this topic takes a long time to um, cover in a video lecture, so I've broken it down into two parts. But with what we'll do in this chapter is to look at how to measure risk and returns, and then we'll also see that there's two different types of risk. That's a that's a systematic risk and unsystematic risk, and it turns out that um, financial markets only provide a return for systematic risk. And you might have heard that higher risk means that there's higher return. Well, it doesn't mean that the return will be higher. It's just that the expected return is higher. And higher risk also means that there's a chance that the return will be zero or even negative, right? It's only in average terms we call it expected return, right? That would be higher if systematic risk is higher in asset. So it's not the total risk, but we'll get to that. And you might have heard of the term beta. Beta is a measure of systematic risk. And we'll get to be talking about a very important breakthrough in finance that happened about 50 years ago, and that is the development of a capital asset pricing model which associated return with systematic risk. Right? And a couple of people have received the Nobel Prize for that development. But let's start by measuring return and risk. Right? So here, when we're looking in the future, right, we don't really have any particular return that is guaranteed. We can maybe assess some probabilities, look at what could happen in the future. So we're just talking about the next period. The next period could be next month, next year, or even the next day. But the expected return calculation over the next period will take into account different things that can happen, different outcomes, and the chances or probabilities of those outcomes. So here's an example. Enron Corporation, its management expects investors to buy into its accounting gimmicks with a probability of 60%, when Enron stock will return 30%. There is a 30% chance that some investors will be wise to Enron's gimmicks, but the information will trickle over to only a few investors, and its stock's return will be a modest 10%. An off-chance prediction with a probability of 10% suggests that Enron shareholders will recognize the accounting manipulations, and its stock return will be a negative 10%. Right? So, what is Enron stock's expected return as per its management's expectations? I'll say that the expected return is simply an average return. In this case, it's going to be an average rated by probabilities. The probability of getting a 30% return is 0.6 or 60%, right? The probability of getting a positive 10% return is 0.3. And the probability of getting a negative 10% return is 0.1. And so what we need to do is multiply each probability with the return and add them up. So here this notation says R with the caret on top. That's typically universally use notation for expected return, right? If there was just a bar on top, we'll be talking about a simple average. And we'll talk about that too in a few minutes. But the expected return, another way to say it is the expected return on S, that R of S is the stock, S stands for that stock, right? But the expected return is simply each outcome's probability multiplied by the return on that outcome, and all of those are then added up. In this case, we had 3 outcomes, right? And of course, all the outcomes, the probability should add up to 1 or 100%. So 0.6 and plus 0.3 plus 0.1, they will add up to 100%, right? So the 0.6 is the probability of getting a 30% return. 0.3 is the probability of getting a 10% return. 0.1 is the probability of getting minus 10% return. So if you do the multiplications, 0.6 times 30 is 18% here. 0.3 times 10 is going to be 3, right? 3% here. Then 0.1 times minus 10 is minus 1. So 18 plus 3, that's 21, minus 1 is 20. So we have an expected return of 20%, right? So note that the expected return is not one of the outcomes we actually think will happen, because we think that the return is either going to be 30% or 10% or minus 10%. And it's never going to be 20% as per our expectations. Yet this expected return calculation gives us an answer which is 20%. So think of it as being an average. It is one number that summarizes all of this information for it. And when we calculate this one number similarly for all of the other assets, we'll be able to make comparisons, right? But it's an average. It is a weighted average, weighted by these probabilities. If each of these probabilities were equal, right? So it was 1/3, 1/3, 1/3. Then what we get is a simple average, right? Which is simply 30 plus 10 minus 10 divided by 3, right? And that would be a simple average. But now we're talking about a weighted average, which is with different probabilities, right? So it's 20% is the weighted average. That's the expected return. Okay, so here's another one. Modesto Incorporation makes an immodest projection of being able to earn a return of 50% on their investment if the economy takes a dive, and 100% when the economy is hot. So if the projected probability of a hot economy is 60%, what is Modesto's immodest expected return? Then what is the standard deviation? A standard deviation is a measure of risk, right? So let's first look at it this way. We were told that the economy being hot, the probability of economy being hot is 60%, right? And there are 2 outcomes. So if one has a probability of 60%, then the other has a probability of 100% minus 60%, or 1 minus 0.6, which equals 0.4, right? And so that's the 40% is the probability, and in this case, the company has a 100% return with a 0.6 probability, and the other outcome of 0.4 probability, it has a 50% return, right? So if we carry out the multiplications, 0.4 times 0.5 plus 0.6 times 0.1, of course we got to do the multiplications first, right? So so this is 0.6 over here, and this is 0.2 over here, 0.6 and 0.2 added up, will give us 0.8 or 80%. So that's the expected return for the stock. Now, for the standard deviation, the actual return expected to occur, of course, is not 80%, right? We know that the actual return is either 100 or 50. So the difference between the return in each state and the expected value is called the deviation of that state. Then what you need to do is take the deviation in each case. In this case, here we only have two cases, right? We take the deviation in each case, square the value, and multiply each with its associated probability, right? So the answer is going to be 0.06, right? Let's just do this in the calculator. So 80% is actually the expected value, right? We're going to do this all, we're keeping it all in decimals because otherwise things can get a little confusing. But 0.5 minus 0.8, so the actual return in the cold economy minus the expected return we calculated earlier equals minus 0.3. Let's square it. Let's square that value. And when you square it, we get 0.09. Right? Why do we square it? Because otherwise, negative deviations and positive deviations will cancel each other out when we add them up. Right? So we square those values, and then in the end, we're going to take the square root. Right? So 0.5 minus 0.8 squared is 0.09. Multiply that with 0.4. Multiply it with 0.4 equals, we get 0.036. Store that number, SDO1. Then we will do the second part, 100% return minus the 80% return. 1 minus 0.8 equals 0.2. Square that value, x squared, and we get 0.04. Multiply with 0.6, that's 60% probability of having a hard economy. We get 0.024. Then, I'm just going to store it for safety, but we need to take this number and add to it the number we had calculated before, stored in the first memory cell. So plus recall 1, we get 0.036, and eventually we get 0.06, right? So this 0.06 is actually the squared deviation time probability in each state. All of those added up, right? So what we have is a weighted average of squared deviations. This has a name too. It's called the variance, right? Denoted by sigma squared. But what we are after is the standard deviation. The standard deviation is square root of the variance, so we take the square root with the square root button, and we get 0.2449, right? 0.2449, or 24.49%. And so that's the standard deviation, and we use that to measure risk. Okay, so this was looking forward, right? Suppose we want to look back, because sometimes looking at history also provides us with the useful information, right? So here's a whatchamacallit mutual fund, and it's got these following returns over the last 5 years. So in year 1 it was minus 9%, then minus 5% the second year, 15% the third year, 21% the fourth year, 24% the fifth year. So we have 5 years of returns, right? And from this we're going to draw some conclusions, like what has been the average return, right? We got to find the average annual return. And these things have already happened. This is in the past, right? Last 5 years. So we don't have to worry about probabilities of things occurring because this has already occurred. What we are simply going to do is get an average of all these 5, which is a simple average, right? And that would become a marker that we can use the average return on one stock and compare it with another stock, etc. And also we calculate the standard deviation to see how much risk there is. See, you can see that the returns vary a lot. They fluctuate a lot from one year to the next, right? So, so with the historical series, of course, there's no probabilities to consider. We simply compute the average return of the series and then the square root of the average of squared deviations. So we'll take the squared deviations, we will take their average, that becomes the variance, and the square root of that average of squared deviation is the standard deviation, right? So calculations are simpler this time because we're not having to probability weight anything. They're all equally weighted, so you just add them up and divide by 5. So here we have 5 numbers, minus 9, minus 5, 15, 21, 24. We add all those 5 values divided by 5, and we get 9.2, right? Now, for the standard deviation, we get an average, the average of squared deviation. So we're taking the deviation each time, squaring it up, and adding them up, and then we would divide by n to get a standard deviation. However, if we're dealing with a sample, for instance, that whatchamacallit fund has been in existence for more than 5 years, but we're only looking at a 5-year history and drawing implications for that. And what we did was we calculated an average based on 5-year history, and we said that's the average return for the stock. Well, since we didn't look at the entire population, there can be some error in it, right? And we take that average here to find the deviations, and then we use that for making another inference. And what we are doing is then we're compounding any error. So to compensate for that, we do something that's a conservative, make that estimate more conservative by dividing this number not by n, right? So we had 5 years of data. We wouldn't divide it by 5. We wouldn't divide the sum of square deviations by 5 to get the average, but we'll divide it by 5 minus 1 or 4 to get the standard deviation, right? And statistically, you say there's been one lost degree of freedom, right? So if we do the calculation, we had calculated 9.2% was the average, right? And the first year's returns minus 9%. So minus 9, subtract from that the average, minus 9.2, and then square that value, right? And you do the same thing for all of this, minus 5, minus 9.2 squared, etc. We got 5 numbers, so we'll have 5 squared values. We'll add them up and then divide it by 5 minus 1, or 4, and we will get 15.2%. Right. Now, this time the calculation is simpler, but it's longer, right? Why? Because we had 5 years of data. But we didn't have to do any probability weighting. In this case, when we're looking at historical data, we actually can do this with the stat functions in your calculator, right? So here's how it's done, and let me just click through. So here are the instructions, but let's go ahead and do this in the calculator. So we need to get to the data mode, second, and 7, second and 7 is data. And I just got in there, and there's something in here, in my calculator from a previous calculation, so I need to clear that. For that, I need second C/C, right? And that's that. Now, we had 5 years of data, and the first year it was -9. And let me take a peek back over here. Yeah, so first year it's -9. So back in the calculator, I put 9 plus minus, then enter, and that's x1, right? Go down, and there's another, the next, if you use the down arrow key, you go to the next item here in data mode, and it says y1. But we're only looking at one thing right now. It's one variable stats. So go past y1, and when you see x2, well, the next number was -5. I may have changed the order. No, I think that's right. -5, but we just need those 5 numbers. Doesn't matter what order we put them in, right? It's the 5 years of return. All right, so -5 is the next x value. Go past y2. We're only looking at x's, only one variable. And for x3, input 15. Go past y3. For x4, input 21. Then enter. And then go past y4 to x5 and input 24 and enter. Okay, so now we need to look for stats, right? And for that, you want to do second and 8. So second and 8 brings me to stat. You should see one variable, one v, up on the screen. If not, because we're only doing one variable statistic right now. And if you don't see one v, if you see something else, just push the set key, which is second, enter, right? Do it as many times, second, enter. Do it as many times as it takes for you to get one v on the screen. And now that you see one v, start to arrow down. N is 5, it says there are 5 numbers we inputted, which is fine. X bar is 9.2, so 9.2% is the average value that we had calculated earlier. Then S of X is 15.2%, right? And that is the standard deviation, sample standard deviation that we were looking for, right? So it gives us that. If you go back to the calculator and go down some more, you see sigma x, right? Now the sigma x is actually population standard deviation. So if this was the population, right? If this was a population of returns, what we will see is we won't need to do this -1 adjustment in the denominator, and we'll divide the sum by 5, then take the square root, and what we will get is then call this the population standard deviation, right? Once again, what would make it a population? Say, for example, we were told that this whatchamacallit mutual fund has only been around for 5 years, and here's 5 years of data, right? Then we have the entire population of data. But since we weren't told that, we can't assume it. We'll have to go by a more conservative assumption that we are only looking at 5 years of data for something that's been around longer. And then that makes it the sample standard deviation. And so we need this adjustment, 5 minus 1. But just want to let you know that in the calculator, that sigma x is actually population standard deviation, and the sample standard deviation is noted as S of x, right? but it does make calculating standard deviation much easier, right? Your calculator is pretty handy that way. Okay, I think we need to run through this. I just saw how to do this. We can calculate it and see we are looking for x bar and s of x, right? Not sigma x in the calculator. Okay, now let's look at some how we can use standard deviations and expected return. So Pitbull Manicure is in a high-risk business. Its expected return and standard deviation are 22% and 40% respectively. Yorkie Grooming Company has an expected return of 15% and a standard deviation of 25%. Which is a better investment, right? How can we find that? Well, we know we can look at the Pitbull Manicure. Well, it has a expected return of 22%. Yorkie Grooming only has a return of 15%. So Pitbull Manicure looks better at first glance. But when we look at the standard deviation, it also says Pitbull Manicure is a higher risk investment than Yorkie Grooming. So it's got 40% standard deviation. Yorkie Grooming only has a 25% standard deviation, right? So we won't be able to pick one. Remember, standard deviation measures risk, and of course, return measures the expected or the average of benefits, not the actual. So if both of them have the same return, then we could just go with the lower one with the lower risk. Or if both of them had the same risk, then we could simply go with one that has higher return. But that's not the case. So what should we do? Well, why don't we find out how much risk we are taking for each unit of return, right? And that is called coefficient of variation, right? So coefficient of variation, CV, is simply standard deviation divided by expected return. So if we do that for Pitbull Manicure, its standard deviation is 40% and expected return is 22%. We do the carry out the division 40 divided by 22, we get 1.82. For Yorkie Grooming, 25 divided by 15 gives us 1.67. All right, so what do these two numbers mean? Well, now we have a per unit measure of risk. So we've got risk of per unit of return. In other words, for each percent return we get for Pitbull Manicure, we're taking 1.82% in risk. And for each percent return we get for Yorkie Grooming, we're taking 1.67% in risk. So it's lower risk per unit of return for your Yorkie Grooming, right? And hence we should pick Yorkie Grooming as our investment. Remember, we always want less risk and higher return, but if if the return and risks are different, then we can do this coefficient of variation calculation, and it tells us how much risk we are taking per unit of return. So we should pick Yorkie Grooming because it has less risk per unit of return. Okay, now what about portfolios? What is a portfolio? Well, most people don't really have all of their investment in one stock, and that's actually not an advisable thing to do. So you would probably have a portfolio of stocks and or portfolio of assets. Right now, you could have some real estate. You could have some stocks, some bonds, mutual funds, etc. But the returns from portfolios are dependent on the individual items within the portfolio and how much of your money is invested in each item, right? So portfolio return is also it's a weighted average return, but we're not talking about probability weighting, but rather we're talking now about weighting with proportion of investment. So it's proportion weighted average. So let's look at this problem. Forrest has 40% of his wealth invested in some fruit company stock, 30% in Shrimp and Boats Corporation, and the remainder in Smiley Face T-shirt company. Over the next year, the expected return on some fruit company stock is 20%, Shrimp and Boats Corporation is 10%, and Smiley Face T-shirt companies 5%. Right? What's portfolio's expected return? So, suppose Forrest has $10,000 in investment, right? And then 40%, $4,000 is going to be then invested in some fruit company stock, and then another 30% or $3,000 in Shrimp and Boats Corporation. And the remainder, well, what would be the remainder of 100% of his money? 40 plus 30 or 70 is already gone. So 100 minus 70 is 30%. So another 3,000 or 30% of his 10,000 would be invested in Smiley Face T-shirt company, right? And the portfolio return is simply then a weighted average based on proportions. So 40% was invested in some fruit company stock. We'll take that and multiply it with some fruit company's return. Expected return is 20%, right? Then Shrimp and Boats Corporation, there was the next one, which had a return of 10%, and 30% of his money is invested in that. So 0.3, right? And then Smiley Face T-shirt company, 5% return, 30% of the portfolios invested in that. That's the proportion. So we take each company's proportion in the portfolio and multiply it with the company's expected return, or the stock's expected return, and then add them up, right? So once again, we're calculating a weighted average, and the answer comes out to be 12.5%. All right, so here we're going to be talking about correlation, right? It says Grandia's Lobsters Incorporated has a customer base of elite and expensive restaurants throughout the nation. The Shrimp and Boats Corp has a customer base of modestly priced restaurants. Would the correlation between stock returns about two firms be positive, negative, or zero? Explain, right? Given your answer above, what's the implication of such correlation and diversification achieved from a portfolio formed by combining the above two stocks? Right? And of course, chapter 6 does familiarize ourselves, you with the notion of correlation, if that's something new to you. Correlation between two assets is a measure of how they vary with each other, okay? And a correlation coefficient is basically the correlation is coefficient is a standardized covariance, right? And there's some formulas shown in your book, but the correlation coefficient is the covariance of returns between two assets divided by the product of the standard deviation of returns in two assets. And when we get that, we get a correlation coefficient, right? And that can be, by doing that, we get, by dividing covariance with the product of standard deviations, what we're doing is we're getting a measure which we call the correlation coefficient, right? Which is bound between the values of +1 and -1. Right? Simply speaking, if we have two companies like Grandia's Lobsters and Shrimp and Boats Corporation, and their returns are not identically moving together, like if return of Grandiose lobsters goes up by 10% and shrimping boats also goes up by 10%. And if Grandiose lobster return goes down by 20%, shrimping boats also goes down by 20%. And if that happens on a consistent basis, then those two companies, their returns will have a correlation of +1. And basically that means that we're not going to get any diversification benefits. We could talk about that in a second. But because Grandiose Lobsters has a different client base, right, and shrimping boats has, then shrimping boats, we will see that the correlation between the two will actually be negative. It's going to be less than 1. So Grandiose Lobsters and shrimping boats typically cater to different clienteles during normal times. Generally, the more prosperous will dine at Grandiose Lobsters, while the less wealthy will dine at Shrimping Boats Corporation, right? However, during an economic boom, more people can afford to and will dine at Grandiose Lobsters. So the result will be more business for Grandiose Lobsters and less for Shrimping Boats. But the reverse is true during times of economic recessions, right? And now what we're leading to is that the correlation between these two are going to be negative. As such, we should expect correlation between these two stocks to be negative. When Grandiose Lobsters returns go up, Shrimping Boats returns will go down, and vice versa, right? Well, with negative correlations amongst each other, these two stocks are good diversifiers of each other. Hence, including both of these stocks in a portfolio will serve to reduce the portfolio risk in a very efficient fashion, right? And of course, all right, so we're going to talk a little more about diversification with this next problem, but let me just take you to an example here, an Excel worksheet. We've got two stocks, Alpha and Bubba, and their average return and standard deviations for Alpha is 10%, and the standard deviation is 15%. For Bubba, it's 25% and 20%. But what is important is the correlation between the two, right, which currently stands at 0.2. And what we have is a chart. This is a graph of various combinations of Alpha and Bubba. Say I have $10,000 to invest in both. I could invest $1,000 in Alpha and $9,000 in Bubba, right? That gives me a portfolio. I could invest $5,000 in each of the two stocks. That gives me another portfolio, right? And so here are several portfolios. First, we're not combining anything. It's all Bubba. Bubba has 25% return and 20% risk, right? So this is going to be at the top of this chart is Bubba's risk and return profile. So risk versus return. Now, on the other extreme is 100% in Alpha and nothing in Bubba. And that has a return of 10%. Alpha has a return of 10%, risk of 15%. So 10% return, 15% in risk, right? So when we talk about getting diversification benefits, what we're saying is because these two stocks don't move together identically, right? And that would mean that these two stocks will have a correlation of 1, right? So if I change it to 1, what we'll see is that the return and standard deviation for these various portfolios, right? We get 10%, 90%, 10% Alpha, 90% Bubba, that's one portfolio, 20% in Alpha, 80% Bubba, that's another portfolio. And if the correlation between the two is 1, then combining the two will actually enable us to get to points in between, right? And so, but it's not going to give us a lower risk and higher return portfolio. In other words, we couldn't get higher return without higher risk, right? Um, and that is when they have correlation of +1. Now, if the correlation were between the two were identical in the opposite directions, in other words, if alpha's return went up by 10%, Bubba's return would go down by 10%, and vice versa, then the two stocks will have correlation of -1. So if I put in a correlation of -1 here, look at what happens to the chart. We actually get, there's one particular combination that gives us 0 standard deviation, right? And that's this combination. That's why you'll see in the table we get 0, 10, 20, 30, 40, going in increments of 10%. But after 50, the next one is 57 in alpha and 43 in Bubba. And why is that? Because with the -1 correlation, that is the combination that gives us 0 risk portfolio. And there's ways of determining what a combination will give us a 0 risk portfolio with any two given stocks. Now, so we get one combination which has 0 risk, but of course we have others too that are of interest. If I wanted to say I'll be happy with 10% return, well, I can actually get a whole lot more than I could just get with 15% risk in Bubba, right? With 10% risk now I can get more here, but even more there, right? More return there. All right, so that's interesting because it gives us one 0 risk portfolio with some positive return. But if we are selecting stocks at random, right, we're probably not going to get +1 or -1. I mean, those are two extremes. So for instance, in the last example, we saw two stocks that may have a negative correlation, and it may be something like minus 0.5. Oops, minus 0.5, right? And those were grandiose lobsters, and the shrimping boats, right? Those two companies, and we saw one was but they had negative correlation. Now we'll get combinations like this. Of course, all of these combinations are inferior because you could take any given level of risk, and for that risk you can generate much higher return with a different combination of the same two stocks. And that's what we mean by getting benefits of diversification. Or by combining the two stocks, we could get a portfolio that has much less risk than any of the individual stocks alone, right? Generally speaking, when we pick stocks at random, we actually will see most stocks will have some sort of some sort of correlation with the market. So something like 0.2 or 0.3, 0.4, those correlation with other stocks, because most stocks do have, do go up and down with the market a little bit, right? Not exactly in like fashion. So we have interest rate changes will affect most stocks in a similar fashion, even if not identically. And so something like 0.4 is a more realistic assumption of correlation between two stocks. Well, if it is 0.4, what we still see that there are benefits of diversification, because you could get portfolio which has a risk less than either of the two stocks, right? Less than 15% or less than 20%. We have, you can see the standard deviation of the portfolio. You can see that it keeps going down until this point, 70% in alpha, 30% in beta, right? The standard deviation is 14.02, so that's the lowest risk portfolio. But we don't need to, only want lowest risk portfolio. If an investor was okay taking 15% in risk, well, you could do a lot better than simply investing in alpha, because there are better combinations, right? There's a better combination up here that for the same risk will provide a higher return, and that's the benefit of diversification, right? You get low risk portfolios, and you could get decent returns while lowering the risk of a portfolio um, by picking stocks at random. And so that is the topic of this question. It says Casino Royale has a roulette wheel made of cork. You decide to take a page from Wall Street Journal quotations and paste it on the wheel. Then you spin the wheel, blindfold yourself, and throw darts on the wheel. You pick stocks based on where the darts land. Your best friend Jamie says that you should save time and effort by investing in the first stock you pick this way. According to him, there's no point in picking more than one stock when you're picking them randomly. So what's your response to Jamie? Frame your response in the context of systematic versus unique risk, right? So you should start out by telling your best friend Jamie that, Jamie, you the fool. Because any two stocks picked at random will typically have less than perfect correlation, less than +1, right, with each other. As such, we can obtain diversification benefits from combining many stocks to form our portfolio, even if we're picking these stocks at random, right? So let's take a look at how portfolio risk declines. And there have been many studies done in the past which measure the standard deviation of the portfolio as we start to add more stocks to your portfolio. So randomly pick, look at pick a stock and measure its standard deviation, and you do that for 1,000 different times, and you average those standard deviations. And for one stock portfolio, you'll see we get something like 35% standard deviation. Right. Now, repeat the process, but this time we pick two stocks at random, and we're just combining them 50-50, right, and measuring its standard deviation. And we do that thousands of times, and then average those out, and we get, for a two-stock portfolio, or something like 30% standard deviation. And you can see that we have a pretty steep decline in risk of the portfolio just by combining two stocks into a portfolio. Rather than putting all your money in one stock, we got a two-stock portfolio, right? Of course, if we took the whole market, which will have thousands, thousands of stocks, and we basically got the standard deviation of 1,000 stock portfolio or more, we'll see that on average we get a 20% standard deviation. So this is basically something that comes from market forces, right? So for a two-stock portfolio, the total standard deviation is 30%. The first 20% comes from market forces, and we call it systematic risk. Now, what kind of market forces are we talking about? We're talking about changes in interest rates. We're talking about the economic cycles, going through booms and recessions in the economy. And, those are things that will contribute to what we know as systematic risk, right? And there are ways to manage this systematic risk, but we cannot get rid of it simply by diversifying the portfolio. But simply by adding more stocks into a portfolio or spreading your wealth across different assets, many different assets, you can get rid of much of uh, this risk, right? And we call that, so for a two-stock portfolio, uh, the 30 minus 20% is the diversifiable risk. We call it diversifiable because it can be easily diversified away by having a multiple stock portfolio, right? So this is a diversifiable risk of an equally weighted two-stock portfolio. Remember, we're just doing 50% in one stock and 50 in another um, to in this experiment. But that's a diversifiable risk, meaning that you can simply diversify that risk away by investing in more than one asset, more than by adding more assets to the portfolio. Um, and so the diversifiable risk typically can be attributed to company-specific factors. It turns out that it doesn't take much. Oftentimes, as little as 40 stocks can get rid of most of this diversifiable risk, right? And get us very close to a portfolio that only has systematic risk. All right, so why does this process work? This process works because the total risk from investing in a company's stock comes from two sources. The first is the company's exposure to economic factors, such as interest rates, business cycle stages, etc. This is called systematic risk, right? It's also known as market risk. And since that risk cannot be diversified away, we also call it non-diversifiable risk. And secondly, there are companies' own specifically unique risk factors, such as the quality of its management, its financial health, etc. And that risk is known as the company's unique risk. It's also called unsystematic risk. It's not systematic. It's diversifiable risk because that's the risk that we can get rid of. It's idiosyncratic risk because, well, idiosyncratic is simply another synonym for unique risk, right? So combining many stocks with one another tends to dilute the company-specific or unique risk as we mitigate, for example, the risk of poor management in one company with superior management in another. Or when we pick a company with weak financials and combine it with one with strong financials, etc. Right? So there's an averaging of the risk that starts to take place with the company-specific factors. Hence, it doesn't matter if we only use a random selection of various stocks to include in our portfolio. The portfolio still benefits from the reduction of diversifiable risk, and we end up with more efficient portfolio. So, we say this again, jammy, beautiful. And with that, we end this one.